Hello and welcome to ACNT 1331 Federal Individual Tax with your host Professor Naragon, bringing you Chapter 8. And Chapter 8 is going to be a little bit long one where we refresh with depreciation and sale of business property when it's related to the tax return. So hold on, here we go. This is all related for individually with the Schedule C, which is basically our business property and ourselves. And we're going to get first off with depreciation. And we're going to learn how depreciation works with the tax return. And we're going to have a few little different items, some limits, and then we're going to get into the sales. So this is, again, going to take a little while. So let's get started off with first, again, what is depreciation? Depreciation is a process of allocating and deducting the cost of assets over the useful lives. Due to IRS and GAAP, any big ticket items, stuff that has a long life and is used in the normal course of a business, has to be depreciated. We can't take all the expense at once. And they tell us that we can slowly siphon off the cost and deduct it as the years go, however long the product lasts for. This does not mean that the asset's being devalued. It still stays at its cost, but it has to deal with really just us getting to finally expense out what we paid for it. The only one that doesn't ever depreciate is land. No matter how much we pay for land, we cannot expense it. It is stuck as an asset on our balance sheet. And that's just the way it goes on land, because again, land doesn't really deteriorate. Other assets do. And when we're looking at these assets that depreciate, we're mostly looking again at furniture, equipment, vehicles, buildings, and those in nature. So if you have to, go back to your accounting 2301, check out that depreciation chapter, which just happens to be, I think, chapter 8, I think, if I remember right. Ironically, 8 and 8. So 8 is a great chapter to depreciate. Oh, that was so bad. Maybe you laughed a little bit. I don't know. That sounds like something I would do in my lecture now. Oh, this is a lecture. Woo! Anyway, the other part of this this little slide here is maintenance versus depreciation. Maintenance is really just something that affects the current period, or basically is only really used in 1 year, and it doesn't really extend the life of the asset or help modify it to a point where again it extends life. So we're not going to really have maintenance part of depreciation that we get to expense in the year. That's repair and maintenance. So the example I like to use with this is always vehicles. Now, we don't depreciate getting the vehicle an oil change. That's just part of maintenance. If it happens to be a semi-truck, tires tend to go out every year also, since they travel so much. Well, that will be a maintenance expense. But if the engine goes out and we replace the engine or transmission or anything major mechanically, those are things that we have to depreciate, because again, basically that vehicle was dead to us with a bad engine. We replace the engine and guess what? It lives for a longer period. So that's a little bit of what depreciation is. Now, again, if you reference 2301, you learn 3 methods. You learn straight line, you learn basically units of operation, units of output, and then you learn double declining. That's great for book. Okay, tax likes to do it a different way, and their system is known as the modified accelerated cost recovery system, or better known as MACRS. And MACRS in itself is really only specified for the IRS, and they tell us what they think the life is. And we'll get into this with examples and so forth, and we'll let you know how this goes. This is actually pretty easy for us, and you're going to see why. The hardest part is knowing where the category the asset will fall into. Well, 3 years asset depreciation range is basically going to be for software. Usually software is the only one that hits the 3-year market. 5 years tends to be for computers. Normally, some office equipment ends up falling in the 5-year range. Cars and light trucks, R&D equipment, those are 5-year stuff. 7-year tends to be mostly any business furniture, equipment, and property with actually no asset depreciation range, that or ADR. And then we have these other years. We have 10, 15, 20, 27.5, and 39. These right here are dealing with basically improvements, either improvements to land like trees, sidewalks, roads. And a lot of the sidewalks and roads and parking lots hit this 15-year mark, while vines and trees tend to go 10-year. Now these 27.5 and 39-year, that's going to be for real estate, and we're going to get into those in a little bit. But how does this work? Okay, and you notice the PowerPoint is selecting, but this is the actual chart. We use this chart to basically get our rates, and as you can see, it's already really done to us, for us. And all we have to know is what is the year range. So if you have to, again, here's more examples that the book actually does tell you. And 5-year, there's all the office machinery, again, certain things like faxes and stuff like that, fax machines, copiers. This is business furniture and other equipment, and as you can see right here, 10-year, trees and vines, 15-year, sidewalk, roads, fences, landscape, a lot of land improvements. 20-year, we don't really do a lot. That's usually basically for shorelines, so we're not going to really use that one a lot. But let me close that out. But as you can see, here we go. We're going to take these percentages and we're going to take whatever the cost is, or how much we paid for the thing, or how much we have to capitalize. So basically the cost in getting the asset ready to be depreciated. And we're going to take the cost and times it by the percentage. Okay, whatever the percentage is. This example right here is a 7-year. So again, they're taking, oh wait, no, it's a 5-year. Sorry, 5-year. And they're taking these percentages and basically times them by the cost. Remember, these are percents, so you need to convert them to decimal. So this is actually 0.2, this is 0.32, 0.192, and so forth and so on. And just basically times it by the cost, and that will give us our depreciation for that year. Again, if it goes for the whole term, it will cost out. Okay, and that's really the nutshell makers. And we're going to be using these tables a lot. So again, this is usually on personal property, something that's 20 years or less. And most makers is going to be using the half-year convention. This is what this one is. This percentage is the half year. So I would definitely have this chart in handy when it comes to answering questions. Now, it does tell you that salvage value is not used. Taxes don't care how much value you think that you can get it for. That's when we calculate gains and losses. When it's depreciation, it doesn't care. It just cares that you times it by the right percentage. So, really, if you look at this table, find the percentage, find the years, and really all you're doing is timesing it by that. So if it says, what is the depreciation of a 13,000 asset that depreciates in 15 years on year 10? Well, I'll go to this chart, find year 10, 5.90 times by 13,000, and there's my depreciation for year 10. We use these charts a lot when it's in Excel for the pure fact that we can basically estimate your depreciation as it goes to either something good or something bad. Now, for property other than real estate, we may elect to use tables based on straight line instead if desire less deduction in early years. We don't usually do that. We keep it with makers. That is basically the IRS appropriate one. Most programs will force you into makers. Alright? So, must use either makers or straight line for all property in given class. Again, we normally use makers. Makers tends to be the best one. And it's usually, again, what the software is going to tell you to, because it helps you out. Now, again, this is using the tables. These examples just did what I just told you. They went and found out that it's bamboo furniture, and we know furniture in itself is a 7-year asset, and we're going to take basically year 1, year 2, take the cost times the percentage. Again, go into the table, there's the percentage, and there we go. And then right here, RFID inventory control system for 12,000. This is technically a 5-year one. This is basically equipment, small equipment, and it will take a 5-year asset. So really the hardest thing is knowing the life. So again, furniture tends to be 7 years. A lot of office equipment will be mostly dealing with a 5-year system. So the IRS does have certain other conventions, and this is known as the mid-quarter. So we're going to get into the mid-quarter, and then there's a monthly for buildings. Mid-quarter in itself will be only used if total assets, more than 40% of total assets, except for real estate, again, real estate's its only thing, this is all personal, was bought in the last quarter of the tax year. So what does that mean? Well, we have to look at when the assets were purchased. And if it was purchased in October, November, or December, we need to watch out. Again, if it's more than 40%, it requires us to do certain items and take the mid-quarter. Little different percentages that will happen. And so when this happens, it's going to apply to every asset purchased in the year. And it will exclude your real property and 179, section 179 property, which we're going to get into in a little bit. Yeah. So this is what that double S stacked on each other. That's basically means section, like what section in the IRS code are. So the IRC, Internal Revenue Code. And we have to use certain tables. So again, coming to your book, this is the tables that we have to use. Okay. Now again, it doesn't show all the years. It's only showing up to 5. But for example, here we go. They use Chavez Smart Build Inc. and they acquire these assets. They acquired one on March 15th and one in October. And as you can see, definitely just viewing 225,000 is going to be greater than 40% of total assets of 275,000. Basically add these two, and if everything bought in the last quarter is greater than 40%, that will tell us that we need to use mid-quarter tables. So when we use those, it's basically, we're going to look at here. This is a 7-year. One was the 4th quarter. Other one's 5-year. So find our 5-year. It was done in the 1st quarter. So 1 year. So we take the cost times 35%. The other one was a 7-year, and it happened in the 4th quarter. So it'll be 3.57 times the 225. So basically 0.357 once we convert the percentage over to decimal form. So you're going to see, you're going to be using these charts a lot. So I would have these always, either if you can, print them out so you can actually use these later as you work, or get good Excel. Put them all in Excel, makes life easy. Excel calculates it all. Just got to punch in the number. So the interesting thing that we've also got, there's other ways to depreciate, and our little special depreciations we call them. And one is bonus depreciation. And bonus depreciation allows us to take depreciation, a lot more depreciation quicker. And it's really only for assets 20 years or less, or basically personal assets. And when they call them personal, it just means that they're non-buildings, non-real estate. So with this, we can take improvements, everything. And before the new law, we were only allowed to take 50%. We took 50% bonus, and then the rest either got depreciated by makers, or it's going to be used in the next thing that we're going to get into, which is section 179. Now, the law has changed. This has expanded the assets we can use, because before with bonus, you could not use used assets. So you couldn't do anything pre-owned. Fortunately, it wouldn't work. But if it's now with the new law, we can use used property as well as new property. And this brings a lot more stuff, a lot better deductions that we can for any business. But it also did this, which is equally cool. Starting in 2018, bonus depreciation has increased to 100%. Means we can take it all now in the current year on our tax return. And this blew people's minds. I'll tell you that. Once this came out, it means assets were buying crazy, because cool thing about taxes is they can influence buying potential like crazy. And this was one. But I will warn you, tax law loves to change, and bonus depreciation changes a lot. So keep an eye on it. Right now, it is currently slated to start in 2023 to slowly be phased out. And this again, your book actually brings out this phase out. So if you want something to actually know later on, this is the phase out going on. Once 2023 hits, it starts to go down to 80, then it goes by 20, all the way 20% each year, until it hits 0. Notice it put a question mark. Again, don't know how the law is going to change by 2027. But right now, it's 100%. And again, in 2017 and beyond, it was like 50%. So it's cool. We love it a lot. I mean, it makes us a little bit easier in calculation because we can actually take it. Now, even though we can take it, sometimes it's not always the right thing. And this is the situation where bonus depreciation and Section 179 both have immediate expensing, but sometimes small businesses won't capitalize such depreciate unless, so they won't take this. I mean, they basically will take this anytime because they love it, but unless they're figuring out that they have an NOL, which is a net operating loss, or want larger depreciation deductions in the future because they're anticipating, hey, we may end up going into a higher tax bracket, they will actually hold off on depreciation, on bonus depreciation in Section 179, because they rather push that deduction later on to help save in case they make more money. So this is something that once you get into the tax world, you start to understand a little bit and be able to figure out what's going on. Okay. So here we go. Here's a personal property example again. And this is Nicole, and she purchased a cherry desk and executive chair. Knowing all this is office furniture because it's using for a business. And she paid $8,150 for it. Okay? Now, it's telling us to use makers and 2018, 2019, and assume that no bonus is going to be taken. Okay? So with this being said, since it's office furniture, it's a 7-year life. So we go right to our chart. And here's our, oh, well, a little bit too far. So here's our chart right here. And 7-year, and take the 2. And boom, there we go. Cool, huh? So again, not too overly difficult. It's just knowing the year life. Okay. Now this brings in real estate. Real estate, yes. So the 27.5 and 39 years, which I said we're going to get into. 27.5 is used for residential, while 39 uses for non-residential, so commercial property. So we have to watch out which kind of one we use. One again, we'll probably use more on our Schedule E for rental, and then 39 tend to be on our actual Schedule C. And they're going to use what is known as straight line method with a mid-month conversion. I know, fun stuff, huh? Another conversion. And this is usually only, this started back in 1986, so mostly anything acquired after the good old-fashioned year of 1986, which is nearly everything nowadays. And these rates can be found, went a little bit too far, right here. So here's the 12 months. So whichever month it was purchased in, we go to that month, and then we go down the rates. 1 year, 2 through 18, 19 through 27, and then 28, 29. That's for, again, more residential, at 27.5 property, and then here is for 39. So again, check the month, then go by the year, and so forth and so on. So when we look at here, that's really all we're doing with real estate. Again, it's just another table. So, and again, this course is trying to get you the basics of taxes. So if you do have questions, always put in the comments below. I'll make sure to get to them. But here's our example. Gwen purchased a residential triplex on August 1st of 2018 for $290,000, which includes land cost of $50,000. What is their depreciation for 2018 and 2019? Well, this is something that you have to watch out for. One, it's residential and was purchased in August. So in our table, this is the one that we're going to use. And again, remember, this is in percentage. You have to convert it to decimal form. So watch out. And you gotta watch out for the cost. Now, she bought it for $290, but it has land cost. Land doesn't depreciate. So we always have to take out land from the overall cost, or basically find our depreciable basis. So our depreciable basis will end up being $240,000, and then multiply by those two. So right here, here's our example. So here's 240 multiplied by the percentages from our table. Again, month 8, August 8th, and that's all we have to do. So seems a little bit easy with these tables. Again, all it is finding cost in the year length. Okay? So here comes a little bit tougher little item. This is section 179. And section 179 was like the greatest thing for her equipment and stuff like that before they changed the law for bonus. Okay? I mean, believe me, if you can section 179, you section 179 everything. And it did have some limits, and that was a little bit tough, but this was used on any personal property used in a business, new or used, and some improvements. And this is usually to rental real estate that helped basically fix up the place. Well, it was only going to be $1 million in the year of acquisition. That's as much as you can actually do. But it was limited on how much you can deduct by two items. One, the cost of qualified property placed in service in a year could not be greater than $2,500,000. Once it reaches that amount, basically section 179 drops dollar for dollar above that limit. So they use this example right here. Assume that we purchased enough assets that were 2,696,000. Taxpayer must reduce Section 179 by 196,000, or basically 1 million minus 196,000, which makes our limit, Section 179, only we can take 804,000 that year due to us buying more than what we should. The remaining asset value is basically depreciated over the asset's useful lives. So again, it's taken the 2,696,000 total assets minus 804 that we purchased, which is basically the limit, and this is the remaining basis that has to be depreciated over the life. The other limit that Section 179 had is it can never be in excess of taxable income. That doesn't mean you can't elect for it. People still elect. It just means it carries over to the next year. So sometimes it's good, sometimes it's bad. And now with bonus, I think Section 179 kind of got a little bit beat out. So again, we use this now for anything before 2018, if you have tax returns before then. But in 2018, if it was bought in 2018, take 100% bonus depreciation if you can. Alright. So when using makers, really what we do first is we have to create the basis, and if we can take Section 179, we tend to take it first, and then we reduce the basis of bonus depreciation, and then calculate makers. Again, with these tax returns nowadays, and because Section 179 has limits, bonus depreciation does not, at least not yet. So keep an eye on the law. Since it does not yet, most people are going to elect just to go ahead and do bonus depreciation and not even deal with Section 179. But of course, you're here to learn. So here we go. We have a nano plant. Their taxable income is 1.25 million. Okay, and they place a 7-year piece of property into service costing 1,839,000 on May 2nd. It was their only asset purchase in 2018. What is the total depreciation, including election to expense and bonus? Now, they choose to elect, well, again, they're under the 2.5 million limit of where phase out starts. So we take the full 1 million. So 1,839,000 minus 1 million equals 839. Then you take bonus depreciation, since it's 100%. Since this is personal property, or how they put it, it's not real estate. Boom, 839 times 100. Take the whole thing. So this is cool. We can depreciate now everything according to the tax return, except for real estate. At least that's what you think. You ready for the mind blown? IRS does not like always to be that friendly. And they have something that they call listed property. And this listed property is property that can basically also be used as personal use. Means it's not completely business use. And this will happen with cars and trucks under 600 pounds and any other transportation, boats, motorcycles, planes, etc. Also, it requires on equipment used for entertainment, recreation, or amusement, since we can probably use them for personal. But the new law removed computers and peripheral equipment from the definition. Because in computers we can do both ways. The law just says if you put it for business, it's mostly going to be for business. When in actuality, we're probably on Facebook all the time. I speak the honest truth. Anyway, so if the asset is used less than or equal to 50% for business, according to the IRS, for depreciation, we must use straight line, and Section 179/bonus is not allowed. Alright, so straight line in itself, again, is basically taking your asset and divide it by the useful life. Okay? Alright, so that's for any type of these kind of assets. Anything that will be considered listed property. But if the asset is used for greater than 50%, we have to use makers. We have to use their code. And this is recorded on part 5 of page 2 of form 4562, which is basically this form right here off the IRS website. Because y'all know me, I like to use these. And this is really how we show 179. Special depreciation is kind of bonus depreciation, and then makers, and then we actually show all of our assets, cost, the recovery period, so forth and so on, depending on the life of itself. And then here's where part 5 comes in. This is the listed property. Mostly your vehicles end up showing up right here if you're deciding to depreciate. And then here's the vehicles right here. So they're going to try to figure out if it's mostly used for business or if it's mostly used for pleasure. And if it's for personal, which includes commuting, then it will have its certain limits. Now, when we're dealing with these, again, we're going to have to deal with other limitations when it comes to auto. And we have luxury vehicles. So luxury vehicles, the IRS limits annual depreciation expense that can be claimed on certain passenger automobiles. So this is actually happening a lot, so here we go. The maximum allowed amount is the luxury auto limits times business percentage use. So if it's used for 100%, we can take the whole thing. If it's not, then we have to basically times wherever the rate is by the percentage. Now, this is the limits that were placed as follows. Currently, what they call a luxury auto, again, any passenger vehicle, placed into service in 2018, basically has a $10,000 luxury limit. That's its upper limit. And then, remember, vehicles depreciate 5 years. But if we do decide to take bonus depreciation, we get $18,000. Yay! So, $18,000. And then starting in 2019, goes to $16,000 we can take, up to that. Then $9,600. And then after that, wherever $5,760 until basically it's depreciated out. Okay, so that's on a luxury vehicle. Usually, again, luxury vehicles tend to be more passenger vehicles, and there are exceptions to this. So as long as it hits one of these exceptions, we're going to be fine. And that includes passenger autos include any 4-year wheeled vehicle manufacturer primarily for the use on public streets and weighing less than 6,000 pounds. Okay, so if it weighs less than 6,000 pounds, that's an exception to the luxury auto limit. If it weighs more than 6,000 pounds, we have to watch out on that. And when we think luxury, think of Mercedes, BMW, actually think of luxury brands. But sometimes a Chevy and a Ford can land into this. A lot of times the big trucks will land into this category. And that's fine. Sometimes it's just better just to take the vehicle and let it go. Now, again, this is more business, big business. But if we're looking at the Schedule C, we're probably going to be taking mileage over depreciation. Again, you can only take either or. Okay? So some SUVs weighing more than 6,000 pounds and so can be expensed under 179 up to 25,000. So we got some SUVs. And again, this changes a lot. So me telling you what exactly they are really doesn't help very much. So they try and be a little bit better on the questions, on not going too in depth. Again, we just try and get you the basics of this law. Well, we use the 5-year maker's percentages without luxury auto limits, and annual limitations must reflect business use percentage. Again, we can only use business use. Usually luxury vehicles, if it's a vehicle being used the whole time, it helps out. But we don't really see much of this, to be honest. So here's the luxury again. So now, subject of passenger automobiles is subject to additional limitation commonly referred to as luxury automobile. And regardless of the thing, it's usually passengers. And it makes it a little bit tough. But we're usually able to keep it going. And I don't like how this one is so big, and this is the IRS code. The Internal Revenue Code, a lot of times, is that it's so vague, and this is why you get the tax court stuff. Again, they're just saying passenger vehicles. So, if it's more than 6,000 pounds, most likely it's going to fall into the luxury auto limits. So, and then how they're going to do it, they're putting it less. But we're just going to go, if it's passenger vehicle, let's use this so that you just get the use of it. Now, Jim purchases a new automobile for $52,300 to utilize in his sole business, and it sells medical devices. It is a passenger auto weighing less than 6,000. The automobile is used 60% for business, and Jim wants to know what's the maximum amount of depreciation he can claim. Well, the regular depreciation is again $52,300 times 20%. Okay, so 20%. Again, this is 5 years makers, and that makes it to $10,460 times business use percentage of 60%. So again, we only used it for 60%. That's all we can take, and our depreciation could be $6,276. Because they're going to consider this as a luxury auto limit, because it's a passenger vehicle and weighing less than 6,000 pounds, we have to also take 10,000 times 60%, which is 6,000, and we have to take the lesser of the two. So since 6,000 is less than 6,276, and usually that's going to be it. I don't really see it ever being different, but we take the lesser of the two, and then you take your bonus, which is an extra 8 grand in the first year, and also times that by the business use percentage. And this comes out to 4,800. Add the two together, and he maximum could take 10,800. Sweet. So technically, you got to take a little bit more than what the makers was going to be. Now, again, bonus depreciation, you cannot take 100% when it's one of these luxury vehicles and how they work. Okay. So, other assets that we can have intangible assets, and intangible assets are assets that include trademarks, patents, goodwill, all this stuff, and they have to amortize in a 15-year period based on the month that it was acquired. So beginning that month, you have 15 years. Can't do anything else about it. Very simple how it is, and it does like pretty much a straight line effect. So again, amortized over 15 years. And again, this is known as Section 197. But goodwill, value obtainable, and covenant not to compete. That's one of those non-to-compete clauses, franchise or trademarks, such and such, any asset that we cannot physically touch. Many intangible assets are excluded from this. I can't speak. Definition, such as interest in land, corporations, partnerships, trusts, or estates. That's an investment thing. That is not an actual attachment. I mean, that's not an something that can be amortized. Wow. However, some excluded items such as self-created assets, film and patents, for example, video recording and interest in films, and computer software usually does. That stuff right there, that's basically going back to franchises or trademarks. But we have to amortize for 15 years. So here we got Fonia Rare Inc. They purchased a small artisan textile company in May 2018 for $980,000. $54,000 of this purchase price was reallocated to goodwill. So how do we amortize? Well, amortize is basically this. We take the $54,000 divided by its useful life, which is 15 years. So I'll divide by 15, and that makes it $3,600 per full year. We didn't buy it in the full year. We bought it in May. So best thing that they tell you is divide by 12 to get per month, and then take that and times it by how many months. Well, this was done in 8 months. We had it for 8 months, so 300 times 8 equals to 2,400. And then after that, it'll be basically 12 months, or 3,600 full year. Okay. That's it about amortization. Yay! Again, a lot of basics going on here, a lot of overview, just so you can get more knowledge. Now, Section 1231 assets are non-capital assets, and they get more tax treatments. Okay, this is really not a capital asset. This is not something that's, I guess you can say, is a building, any fixed asset. This is assets that are basically used more into minerals, we can say. And these assets must be held for longer than 12 months, so longer than a year, and used in a trade or business. And they include basically depreciable real and personal property used in trade and business. So strike that. What I said a little bit earlier. I was trying to think of another better way, but mostly we use a lot of this in material. But this is long term. Timber, coal, or just domestic iron ore. So there's our minerals. Livestock, not including chicken, or poultry. So duck, chicken, whatever poultry that we have, held for certain purposes. Unharvested crops on land used in a trade or business. Notice that property held 1 year or less, inventory, and property held for sale for customer, copyright, so forth and so on, are not Section 1231. So, it's a good fancy name that we like to say. What is it? Basically, this is when we sell a product. We're going to have gains against losses. We get to basically net all the money that we get against our losses. So any money that we lost, or we sold it for less than what the cost was or what it's worth. And again, to find that, we take the cost minus depreciation. This will equal whatever gain or loss we have, depending on how much we sold it for, so cash. So take your cash minus basically the difference of book value, which is your cost, minus depreciation, and that will equal out to either a gain or a loss. It's negative, means we had a loss, we sold it for less. It's a gain, we sold it for more. When we're looking at these, all Section 1231 assets get to be net against each other, and it's usually classified as a long-term capital gain. Again, Schedule D comes back in here. If it's a loss, it's classified as an ordinary loss. So basically, you get the best of both worlds. Hannah Montana, yay, it's the best of both worlds. You get the lower tax rate on gains, and you get no limits on losses. So you can have lots of loss, can affect you, and then you get the low tax bracket of the gains. So, cool little thing, just something to know. Well, there's also something that actually happens. And if you bonus depreciate our Section 179 and you sell it before the life of the asset is done, they're going to have something known as depreciation recapture. And this basically prevents taxpayers from receiving the dual benefits of depreciation deduction and capital gain treatment upon sale of the asset. Again, you just can't depreciate it all and then decide, in year one and then sell it in year two and then trying to have both benefits. Doesn't work. And depreciation recapture requires gains to be treated as ordinary to the extent of prior depreciation deductions, which basically means it's going to go straight to makers, and we have to take the depreciation that would be, and the rest is recaptured, or basically is going to be treated as a gain. Okay, so this is going to have two sections, section 1245 and section 1250. Recapture. Unrecaptured depreciation previously taken on real estate. We're going to get into a little bit later, as it says, see slide 31. Let's see if Cengage actually does that. Alright, so section 1245 applies to property such as personal property, furniture, machines, computers, and auto, and non-residential real estate placed in service between 81 to 86. Because they had an accelerated depreciation, it's okay. We're probably not going to see too much of that. Gains are treated as ordinary income to the extent of any depreciation taken. Okay, so this basically means this. Ordinary income is going to be lesser of A, the recomputed basis. So again, we're going to have to fix the basis because of the depreciation, and minus adjusted basis, or basically the amount realized minus the adjusted basis. And I'm going to tell you this, there's a lot of rules related to this, and this is probably the truest statement right here. There is so much complex rules that it takes another course almost just to learn all these. So we're basically only doing an overview of what is really happening. Okay, so don't worry if you're not kind of understanding what this all means. Basically, again, we're just we're not expecting you to learn all of this. It's just how does the process work, and you don't have to know all the rules. Again, lots of complexity on those. So we're just going to go to an example to show you how this is done. So Francesca sells depreciable personal property used in her business on April 1st, 2018 for the price of $50,000. Okay, so we got $50,000 in cash. It was purchased for $60,000 4 years ago, and she has claimed depreciation on the property of $25,000. What is her section 1245 recapture? Okay, so when we look at this, one, the section 1245 recapture potential is going to be the depreciation, $25,000, because one, that's her complete depreciation she's done. So that's all we could actually throw back in. So what we're going to look at is next, we're going to compute the adjusted basis. So $60,000, which was the cost 4 years ago, minus her depreciation. So basically, this is book value, or tax value, however you want to call it. But this is better, also known as book value. It's our cost minus our depreciation. That happens to be $35,000. Recomputed basis is just basically the $35,000. What was the adjusted basis plus depreciation? So it should go back to cost sometimes. Sometimes it's not, but we're going to assume that it's going to go right back to its cost. And then gain realized is the amount we sold for, so the cash, subtracted by our adjusted basis, 35. So our gain right now is 15,000. If this was negative, that'll be a loss. Okay, so again, this is mostly figuring with more gain. Okay, so our ordinary income is going to be the less of the recompute basis. So again, adjusted base plus depreciation. So it's $60,000 minus our adjusted basis of 35,000, or basically our gain. So our amount realized minus our adjusted basis. The entire gain of 15,000 is considered ordinary income. Again, the 60,000 minus the 35,000 is only 25,000 in itself, is the depreciation. So the entire gain ends up being an ordinary income instead of a Section 2031 gain. That's when we have to basically recapture our depreciation. So sometimes it's good, sometimes it's bad. Yay! But the gain, since it is less than the actual adjusted basis, it is entirely ordinary income and will be taxed as such. And that's really all we're trying to get you, is to know exactly how to do it, to compute these little 4 items, and then basically find the lesser of the two. So next we have section 1250, which is depreciation recapture. And section 1250 applies to depreciable real property other than that identify as section 1245. So, I mean, again, this is something that really occurs. We don't really see much of this, and this requires partial recapture of depreciation. This property alone is mostly, it's very unique, and I don't even remember any examples, to be honest, on this. I mean, gains are treated as ordinary income to the extent of accelerated depreciation taking over straight line. So again, more complex rules, and it does rarely occur. So when we look at this, again, section 1250 applies to real estate, and we don't see that much. Again, I mean, we usually see section 1245 for personal, but not section 1250. So again, this is just a definition to know what it is. But when we look at real estate, now, when we look at unrecaptured depreciation on real estate, so buildings and stuff like that, this requires that portion of the gain attributed to depreciation that is not 1250 or 1245. Again, something that this one happens more often than 1250. So, and it must be taxed at a rate of 25%, or 10% if the taxpayer happens to be in the 10% bracket, 15% if they happen to be in the 15% bracket. So, if they're low income, they have those lower brackets, they get to be taxed at their rate. Beyond the 15% bracket, everything's 25%. Okay, cool. So this is widely seen in practice for rental property, because usually that's rental property is depreciated and sold at a gain. Any gain not attributed to depreciation in excess of the original cost is our 1231 gain. And this does state Medicare surtax. Medicare surtax again is for if you hit those high brackets, and that's when you gotta add that extra 8%. So don't worry, no worries. Okay. And then they try and do this. I love how the examples are trying to throw in the Medicare, but they do say it's non-susceptible to 3.8. So, Elia, however, we're going. They purchased an apartment complex for $7 million. Way to go them. In 1988. Sweet. That thing has to be worth a lot more. But the property is depreciated straight line, and her accumulated depreciation as the sell date is $6,100,000. She sells the property on September 3rd, 2018 for $8,500,000. She happens to be in the 32% bracket. And I believe them because that's a lot of money right there that you're getting. So, we want to know what is her realized gain and how is it split between Section 1231 and 25% rate. Well, this is how it goes. Alright? So, first off, the realized gain is, this is weird, is going to be the $7,600,000, and it's basically equal to $8,500,000 minus $900,000. Well, where do we get the $900,000 from? You're going, well, that's our adjusted base, or basically wherever our cost is minus our depreciation. So that's our $900,000. So our realized gain is really, we made $7,600,000. Yay! There was $6,100,000 of depreciation taken. This will be taxed at the 25%. So the remainder is known as Section 1231 gain. Okay, that's going to be our long-term capital gain, and that's basically going to be the $7,600,000, the realized gain, minus the depreciation. That's going to be taxed at 25%. Will give us $1,500,000, and this is going to be taxed as a long-term capital gain. Fun, right? Y'all just, I bet right now if you're watching this still, your mind is blown, or you're just, you passed out, paused the video, and moved on. Alright, so let's get into a few other items. Again, this is selling of, we basically sold business property and still dealt with depreciation. But here's the other items. What happens with the casualty gain and loss, especially when it's related to Schedule C in businesses? Casualty gain and loss must be computed separate from business and personal. Again, the new law, the TCJA, restricts personal casualty losses to only when federally declared disasters are happening. So it has to be federally declared disaster to be part of a casualty loss. Business, though, and investment casualty or losses results from damage caused by a sudden, unexpected, and/or unusual event. And usually we do it this way. For property that was fully destroyed, say some kind of fire came through, we deduct adjusted basis. So again, the cost minus depreciation. We get to deduct the whole basis. For property partially destroyed, we deduct the lesser of the property's adjusted basis or the decline in value. So we actually have to go find the value. Now, if you get paid insurance, any insurance reimbursed is considered income, and this will reduce the loss that we can actually claim. Okay? And of course, this may actually cause a gain, especially if you get insurance reimbursed and it goes above whatever the loss that we can actually claim. We can actually owe money. And that does happen. Believe me, it does happen. So, treatment of gains and losses depends on the holding period. Again, if the property was held for basically for 1 year or less, so less than a year, the net gains and losses are treated as ordinary, and losses from investment property are separately calculated. So we have to separate per each one. But property held for more than 1 year, the gains are treated like Section 1231 gains. So get that long-term capital gain going on. But losses must have components analyzed separate, and again, a lot of this is very complex, and I would say this: if you like to look at the instructions on these forms, I'm not going to go to them, but look at them and it'll give you a good review of what this casualty loss is. So we're going to finish this up with some other special types of sales. Another sale that we can do is known as installment sales. And this one I will show you because they are very specific on this installment sale. So this is form 6252. So this is an installment sale. And again, we're going to have to go through gross profit and a contract price. We're going to have to find out the installment sale income. We better watch out if it's a related party, because again, related parties have a specific little thing. And look, if you go on IRS, here's the instructions too. I know, lots to read, but believe me, anytime these forms pop up, it does not hurt to just go ahead and read a little bit, because they do change. Okay, now all we do is describe. We're going to calculate the gross profit and basically the income itself, and here's the installment sale, and so forth and so on. So an installment sale really occurs basically with any real or personal property, and it's sold on a note, and payments are going to be collected over time. So Congress actually allows the gain on these to be reported as cash received, not when the sale is complete. Okay. However, you can elect to report all the gain in the year of sale if you just want to get it over with. Some people actually rather do it as the note, and it can actually help you out, because basically you can cover the gain in certain years you can't. So it matters how much tax you're willing to do. So with this, we use form 6252, which I just showed you. And first thing you have to do is you must recapture any of that section 1245 or section 1250 first if it's property, and then multiply percentage by cash received each year, and then calculate gross profit percentage. A lot of times we're going to have interest also, and that's basically what we're going to be electing, is the interest in itself. So how does the computation go? Well, taxable gain again equals realized gain times cash received contract price. So times cash received, and it actually should have been whatever on the contract price. So again, here we go, selling price, any mortgages, and it actually allows you to put in your depreciation, figure out your adjusted base, commissions, income recaptured. So here's our recapture, and so forth and so on as we go through. So when it looks at the contract price, this is just funny. I hate when they kind of drop something like that and don't put the actual thing in again. There you go. So that's just weird. Hey, I don't like PowerPoint, but realized gain divided by contract price times cash received is taxable gain. What they should have done was just take a screenshot of this and put that right there in their PowerPoint. Less confusing. But realized gain in itself is equal to the sales price less than any expenses, less than your recapture, less than your adjusted base. As you can see, it's fun just to use the form because the form lists everything. And then the contract price is basically sales price minus assumed mortgage note. Okay, so fun stuff there for installment sale. And again, there's these complex installment sale rules applied to taxpayers who regularly buy and sell all the time. That stuff we're not getting into. Again, just know the basics and how it's calculated. That is going to be fine for this course. 1031, section 1031, like-kind exchanges. This one tends to be used a lot. I will tell you this, and there is no gain/losses recognized when an exchange of like-kind property occurs. Basically deferred gain and loss. That's what it's called. Most people do this if you're buying property a lot and you basically buy the same thing that you just sold. You get to defer the gain and loss. Like-kind properties transactions usually incurred, again, exchanging real property for real property. As you notice, same thing, like-kind, or exchanging personal property for personal property of the same asset class. Furniture for furniture, vehicle for vehicle, so forth and so on. Rules only apply to business or investment property. That's another thing. Okay? Can't do it for personal. Can't sell your personal home, buy another home. Nope, you're not business. If it was a rental property and you buy another rental property, there you go. And sometimes you do have to recognize a gain if boot is received. Now, this term boot is defined as cash, pretty much. If we receive cash in exchange for any property, inventory, stock, bonds, or other securities, it is not known as a like-kind exchange. Okay? We would have to recognize boot also in any other kind of property for property, personal property for personal property, but we have to watch out for this boot. And that's a good little finance term. Das Boot. Das Cash. And it relieves from the liability and is also treated, there is relief when boot is received. And trust me, we're coming at the end. Like-kind exchange and involuntary conversions is it. So, like-kind exchange models, again, the realized gain equals the fair market value of property received minus the adjusted property basis of property given up. So, really, again, that's wherever, basically, fair market property of property received is wherever the value is as it's currently in the exchange minus basically the cost minus depreciation that you have in your in your property that you're giving up. Recognize gain, so you got realized and recognized gain. Recognized gain is going to be lesser of the realized gain or boot received. Okay, so basically what cash has been received. So if cash is lesser than the realized gain, we have to recognize the cash. If the realized gain is lesser than the cash, we recognize the realized gain. Basis in the new property. Here we go. This is the thing. This is the value of the new property according to our books and according to what we can depreciate. Is the adjusted basis of property giving up plus boot paid minus boot received. So basically cash paid minus cash received plus gain recognized. Okay. This happens a lot with vehicles and businesses. This is why most Schedule Cs will take mileage, because this brings up a lot more tough things that you have to recognize. So, example right here, Barry exchanges his marina in Alabama for Adolph's Missouri land. The marina has a fair market value of $305,000 and an adjusted basis of $175,000. Okay, the land has a fair market value of $305,000, and Barry also gives Adolph $25,000 in cash. What is Barry's realized gain, recognized gain, and new basis in land? So you guys ready? Let's go to this. Okay, so here we go. Again, I wish sometimes they put equals in some of these. It actually helps out. So Barry's realized gain is $105,000, and this is taking the fair market value of the land that he's going to receive, not the marina, even though it's the same thing, same cost. It's basically the land that he's receiving, minus his adjusted basis, which happens to be $175,000, plus the cash that he gives up. So plus the boot. Okay. So again, go into here, minus adjusted base, and they're adding the boot on here. So because he actually gave up money, because we're looking at Barry, we're not looking at Adolph. His realized gain is 0, since Barry did not receive any cash. It will be 0. No worries. So basis in the land is going to be his adjusted basis plus any boot he paid, which is basically right here, minus boot paid, or received, not paid, received, which we didn't receive any money, plus any gain recognized. Well, there's no recognized gain since there is no boot received, and it will be $200,000. So basically, he lost whatever the realized gain was. It came down to $200,000. But you need to follow this way, because in case he did get cash. Now, let's just say we go with Adolph. Now, Adolph, his recognized gain is going to be basically $305,000. I mean, basically that's his gain right there, because he basically only gave up land. He did receive cash, so it's almost $305,000 minus a negative 25. So it's actually, he realized a gain of land plus cash, so about $330,000. The recognized gain is going to be the $25,000, because he received boot, And then so basis in land, well, adjusted basis there is none because it's land, plus boot paid and paid any, subtract by his actual. So this gets a little crazy with land. It should be like, it's a little bit funky, but basically property adjusted basis, property of given up, it's 305. So it's 305 minus 305 plus 25. His realized gain is 25. Recognized gain is 25 because, again, the cash. So, and it's interesting. It's how it goes. So, basically, again, just know the formulas. Again, complexity in these last bit. But, because I'm going to confuse you if I keep going. Anyway, let's finish this off. Last part, involuntary conversions. Gain recognized may be deferred if involuntary disposal of property. So, we can defer in cases of theft, seizure, requisition, and condemn, and insurance proceeds are reinvested in qualified replacement within 2 years after close of the tax year. So we can defer this as long as we do this, basically rebuy the thing. Must recognize gain if insurance proceeds exceed adjusted basis of property. Losses are not deferred. Losses are losses. But we still have to recognize if proceeds exceed adjusted basis. But involuntary basically only deals with theft, seizure, requisition, or being condemned. This rarely happens again, and mostly we still have to recognize the gain. So that's really all it is on involuntary. Again, another just definition, something that deals more with actual business. So that's it for this chapter, and I bet most of you are thinking this right now, and this is the last chapter that we get to deal with a lot of other items. But if you have any questions, please leave a comment below. I will answer them as I can go. If I see a lot on a certain subject, I will probably record a video just to go more in depth of that subject. But let me know anything. So this adventure in chapter 8 is now done. I wish y'all good luck. Professor Naragon signing off.